Welcome back to the channel, folks. This is Jason, host of Fighting Words Financial. How are you doing today? Let's talk about that title, Everyone's Wrong About the Economy. And let me rephrase that a little bit and just say that everyone on YouTube is wrong about the economy. Things are looking enormously positive, even though they're being framed in the most negative way possible. And we're going to go over a couple of headlines to take a look at why that is. And let's talk about what we know about the US economy right now. We are coming out of a pandemic. One of the great things about this economic crisis is people emerging out of this pandemic or out of this economic crisis with more money in their pockets than they have had coming out of economic crises in the past. That is due to government intervention in a couple of different ways and the fact that business disruptions weren't as bad as economists predicted. And the economy has fundamentally changed after we've emerged from this pandemic, meaning that certain people who started working from home are never going back to offices. They're going to stay working from home. I estimate somewhere between 30 and 40% of workers that went and worked from home during the pandemic are probably never going to return to an office full time, maybe 1 or 2 days a week. But that has fundamentally changed the economy. We found new ways to work and do business that didn't require face-to-face interactions. And some businesses are doing much better than they did prior to the pandemic, and some businesses won't come back. This is actually perfectly normal after any economic crisis, not just a pandemic. After every single economic crisis we've had, there was no return to normal. There was a new normal that was being established, and that's kind of what we're going through right now. Now, if you look at your news feed on YouTube, it probably feeds a lot of negative news to you with headlines like, "We need to talk," or "Watch out for this, beware of that." And a lot of that has to do with how that news cycle is created and how your timeline benefits from pushing news that's based on fear and greed out to you, right? That gets more clicks. I'm not immune to doing things like that too. I tend to try to put out, shocking or impressive thumbnails or headlines or whatever just to drive people to click on that. I try not to, make anything clickbaity, but look, we all want to get clicks, and that is what drives the news cycle on YouTube. So if YouTube is your primary source for news when it comes to the economy, then you are definitely getting a biased source of news at this point. In fact, it's feeding you, the algorithm is feeding you exactly what it thinks it wants you to hear, and it's not really giving you, an opinion or a wide range of opinions that's going to help you educate yourself. So one of the things I wanted to do today was take a look at a couple of headlines. Let's talk about why they're not necessarily misleading, but unless you read the article, it's not telling the entire story. And we'll talk about why I think these are really positive for the economy right now. So I've tried to do this in a couple of takes, guys, and I've made a couple of mistakes and had to start over. But I'm just going to continue doing this now, regardless of how many ums and buts I put in there. But let's talk about this. Jobless claims. This headline is, another 207,000 Americans filed new claims last week. Well, that's not necessarily a misleading headline. It's a headline without any context whatsoever, right? And it's just, like I said, it's just designed to get you to see the headline. And it's providing you news and a soundbite without any context or real information behind that. So 207,000, that number presented without any context whatsoever, might make you think that that's a high number for unemployment claims. It's not. It's a fantastically low number for unemployment claims. If you've been in the financial industry as long as I have, and you look at these forward-looking indicators about what the economy is doing, you know that this indicates a strongly growing economy and a strong labor market where there's plenty of opportunities for people out there who want to change jobs. So when people have the confidence to change jobs, they also have the confidence to consume, and that's something else we want to talk about here. But let's look at what this number really means. New unemployment claims rose, but remain near a 52-year low last week. Not a 52-week low, a 52-year low, with the weekly pace of new claims holding it below pre-pandemic levels as the labor market sees job openings near record high. So the headline, kind of neutral, but could make you think that things are pretty negative. But what kind of jobs are being created here? Right? That's something else we should take a look at. So inflation is high. That's something that is a concern for a lot of people. And I hear a lot of people who make $50,000 a year arguing that a $15 minimum wage is going to crash the economy, and which kind of makes me laugh, sadly, in a little bit of a way, because that is clearly an example of how you've been brainwashed into thinking that someone else making more money means less money for you. Inflation is high, but wage gains for low-income workers are higher for now. And this article came out on December 10th from Fortune magazine. So consumer prices rose 6.8% over the past year in the US, the highest number in nearly 4 decades, an increase that typically reduces consumer purchasing power. Some workers are already feeling the pinch, but in an unexpected twist, many of the lowest paid Americans received raises over the same time period that have mitigated the effects of inflation, at least for now. So, U.S. workers at private companies earn an average of $31.03 per hour in November. Over the past year, workers' hourly pay has increased by 4.8%. But when you factor in inflation, real wages are actually down by 1.9% over the last year. And this is for people in that $31 range. Basically, those are folks making $60,000 a year or more. Lower wage workers, though, are faring a lot better. And let's face it, lower wage workers are the backbone of our consumer economy. The more money that they have, the more money that they are going to spend. Thanks to the effect of the pandemic and the ongoing labor shortage, many companies have coughed up high enough raises for their lowest paid workers to mitigate inflation. According to Jason Furman, an economist and professor at Harvard University's John F. Kennedy School of Government, Target, Chipotle, CVS, for example, have raised their minimum starting wages to $15 an hour or more, while 24 states, including California and Florida, continue to increase statutory minimum wage. The bottom quarter of workers have seen wage gains that outpace inflation, according to Furman. He added that those in the second lowest wage quartile have also been seeing enough wage gains to offset inflation early in the year, but that's possibly no longer the case. So real unemployment, cost index, wages and salaries for all private workers, the pre-pandemic trend, and the November 21 trend here. So he says it's much better for low wage workers. The bottom quarter of workers is seeing wage gains outpace inflation, but by less than before. The second quartile has been positive, but now has turned negative. So not entirely negative news, but not entirely positive news here as well. But I personally am really encouraged by wage increases for lower wage workers. I have a number of companies that sell products, and I sell products to everyone, not just to high earners. And the more people that can afford my products, the better business is for me overall. And that is true for everyone who has a business that sells anything. The larger your market is, the more potential you have to make money, okay? And let's talk about consumer demand. Is inflation hurting consumer demand at this point? The answer to that is decidedly no, but it comes from a number that you probably wouldn't think of. So November trade deficit hits near record high of $80 billion. The U.S. trade deficit surged to a near record high of $80 billion in November as exports slowed while imports jumped sharply. Now, on a long-term basis, of course, I want to see our exports increase over time. In a short-term basis, though, I completely expect that the trade deficit is going to be horrendously in favor of our trading partners, just because demand is increasing so much in the U.S. because low-wage workers' earnings have increased at this point. So the U.S. trade deficit surged to that $80 billion in November. The deficit was 19.3% higher than in October. It was a deficit of $67.2 billion. And that was just below the all-time monthly record of $81.4 billion set in September, according to the Commerce Department. This is not a terrible thing, folks. This is a good thing. It means that consumer demand in the United States is really strong. It means that people have money. They want to go out and buy things. We have low unemployment. We have higher wages for lower income workers and strong consumer demand. I think these are all positive things that point to the economy really growing at a strong clip this year. And I think later on in the year, we're going to see that reflected in the numbers. And most of us are going to forget the fear that was drilled into us in November, December, and January. And like I said, I think this year is going to turn out to be another positive year for the stock market. Didn't necessarily think that in mid-2021. But when I look at all of the forward indicators in terms of the stock market and the economy, I think that we're looking at a positive run for the stock market, even in the face of interest rate raises from the Fed. We're probably looking at 0.25% per quarter. That's typically what the Fed does in a rising interest rate environment. Now, if they manage to unwind inflation quickly, because inflation is not simply caused by the profusion of free money that's out there in low interest loans. It's not simply caused by a hangover from all of the unemployment benefits we had out there. It's complex. Not even economists who do this professionally understand every reason why inflation is happening right now. But we are going to see some of the supply chain woes unravel pretty quickly, and we are going to see some constriction in the supply of money. Let's put it this way. If short-term interest rates bumped up to 2% by next year, I wouldn't be surprised. Now, if we have an economy that's growing at about a 2% clip instead of a 3 or 4% clip by the end of next year, I don't see the Fed cutting interest rates. They still want to have some arrows in their quiver for the next downturn that we have. Right now, in a lot of ways, they're kind of out of options when it comes to manipulating interest rates because they've been at zero for so long. And what they're doing right now is they're reducing some of their open market operations, and they're buying up securities on the open market. And that's coming to an end and unwinding. That's going to suck money out of the economy as well. That's going to force an increase in short-term interest rates. But having short-term interest rates at greater than zero is a good thing for the economy. There should be a cost to borrow money. You should be rewarded for the risk you're taking in loaning people money on a short-term basis and a long-term basis as well. So I would like to see more of a normalization in terms of interest rates. I'd like to see the Fed have a little bit more in their toolkit for the next go around in case we do have another recession at some point. And that's going to come one of these days, guys. The point is, you don't panic over these things. If you're well positioned and you have your emergency fund set up, then you can remain rational far longer than the market can be irrational in a lot of cases. And you can use these downturns as an advantage rather than seeing them as an opportunity to panic. Anyway, that is my positive message for today. The economy is in much better shape than YouTube would have you believe, than TV would have you believe. And I think that you guys should have the confidence to still be long-term investors. You should have the confidence to go out there and look for a new job if where you are is not treating you properly. And I want to leave you guys with that message. Everything looks good. I'm enormously positive about the economy, and I hope you have a nice day.